Ladies and gentlemen, welcome to another episode of the Myndful Investor Podcast. This is a special series we're running based on the coronavirus, the epidemic, the emergency, the shutdown, the everything. Alex and I have been doing in-depth dives with experts in the industry, finding out what is going on, boots on the ground. We've also been talking about people on an upper level, and I couldn't ask for a more experienced guest today. Jay Scott, a good friend of mine. I call him a good friend. Hopefully he does as well. But a good friend of mine that we are going to talk on a much higher level, from finances to bigger picture stuff. And this is going to be a great show. So Alex, first of all, how are you doing in your quarantine there in the Bay Area?
Wonderful. You gave me advice to go out and do some fishing. Yeah, I've been cooped up here for now. I think this is week 4. It feels very interesting. I have a very nice office at home. I'm very lucky, very, very lucky to be in this situation, to be honest with you. But it's like house arrest.
Yeah.
You still feel like a little anxious going outside. I mean, we go in the park. I do dojo workouts every day, but it's still this weird feeling. But I want to talk to pre-show. So what we're going to do today, Steve, you and I had this intent is to do some futurescaping. I mean, I didn't really want to do this before because there's no data. Like you and I started this on day 3 of the coronavirus, the big outbreak, beginning of March. And then we really had no data. So a lot of people scared, stock market tanking, what, nobody knows. Now we have some data. We have stimulus data. We have an understanding what unemployment is, what numbers are coming out. We have some notion of what real estate and property management is doing, potential what rents are and are not coming in and what the implications are. So we have a lot of data. So 3 of us are accomplished entrepreneurs here. And Jay, by the way, Jay, welcome to the show.
Thanks so much. Thrilled to be here.
We got to give Jay as much airtime as possible because
Yes.
this one, I follow your stuff and you create very interesting discussions and you don't allow political and opinionated people to pollute your this discussion group that is really based on facts and people's experience.
Yeah, I mean, so I don't like to say I don't make anything political because a lot of what goes on in the world is political. I try and take the emotion out of it though. So I mean, we talk about things like there are people out there that say Trump is doing this or the Democrats are doing that. And that can be factually correct. And we shouldn't ignore the fact that Trump has an agenda and the Democrats have an agenda and the GOP has an agenda and the media has an agenda. We can't ignore that. In fact, we have to factor that into our analysis of everything that's going on. But we can't let our emotions override the facts. And so it sometimes can be really difficult. If you like one party, dislike another party, it's really easy to attribute certain evilness or goodness to the things that they're doing. And so you have to kind of get past that. You have to get past confirmation bias, where we're looking for the data that supports our preconceived notions. But I'm not saying that we should ignore the political aspects. I'm not saying we should ignore even the partisan aspects. What I'm trying to say is we shouldn't let it cloud our judgments, our opinions, and our analysis.
Very, very well said. So Steve, why don't we open up with this shocking revelation from Jay, right pre-show, where Jay said, hey, I just realized I've wasted 2018, 2019. What the heck do you mean by that? I mean, you have a successful business. You're one of the most successful people we know. What are you talking about?
So I learned a lot about myself in 2018 and 2019. Basically, I spent much of my career in the tech world, in the corporate world. I was in the Bay Area for a long time, where you live, Alex, and I focused. I spent about 15 or 20 years focusing on my tech career. Got out of that, and 2008 got into real estate, and I spent a good 7, 8, 9, 10 years kind of focusing on real estate, becoming really, really good at real estate. 2018, I started to get a little bored, and I started to get a little bit concerned about the market and a little bit hesitant to put all my eggs in that real estate basket. And so I started to branch out. So 2018, I started a business outside of real estate. I started to do some more writing. I got into racehorses as an investment, so I bought a bunch of racehorses. I started doing a whole bunch of things that were more business related, or some business related, some real estate related, some other asset classes, some writing, some this, some that. And my thought was, okay, I'm in a point in my life where I've kind of gotten good at real estate. I can put that on autopilot. I've gotten good at other things, put that on autopilot, and I can just branch out and do what's fun. And what I realized is, while I had a lot of fun in 2018 and 19, because every day I just kind of woke up and I worked on what I wanted to work on, I woke up after 2 years and I realized I had accomplished very, very little. Because I hadn't focused on anything, because I hadn't set goals. I mean, my goals were basically daily goals. Like, what do I want to do today? And so I never really made major strides in anything that I was focused on. And again, I was having fun, but from a productivity standpoint, I basically look at 2018 and 2019 as 2 lost years. I could have made tremendous strides in real estate efforts. I could have made tremendous strides in starting a business or investing in businesses or writing 3 more books, but I didn't make tremendous strides in anything because I didn't focus. And what I started to realize talking to other entrepreneurs, other investors, is so many of us make this mistake where we get in this position where we don't have to be focused on something because we have either enough cash flow or we have enough, our business is on enough of autopilot that it doesn't need us day to day, that we say, okay, now I'm going to do something that I enjoy doing and I'll be successful there. And what I find is, without that focus, without those specific goals in one area, it's really easy to just kind of get a year or 2 down the road and realize I didn't really accomplish anything significant.
But Jay, let me ask you this, from an entrepreneur like myself, who's always out grinding, that has a hard time appreciating the good days. Isn't there something to be said with just doing what you love doing? Isn't that kind of a recharge from a personal level? Maybe not financial, maybe not, anything else, but just to say, man, I'm happy today. Isn't there?
Absolutely. Here's the thing. I can be happy focused on something. And I think that's what I was missing, was my typical life since 2008, since becoming like kind of self-employed, has been, I'd probably say 60% of my time really heads down focused on whatever it is I'm trying to achieve. And then I spend about 40% of my time branching out. So learning new topics, thinking about the future, trying to find trends, or whether it be economic trends or market trends or trends in whatever industries that I'm looking for, to kind of figure out where do I want to be in a year or 2 or 3. So I spend about 30-40% of my time kind of doing other stuff anyway that I really enjoy, that lets me kind of think about the future. And then I spend about 60 or 70% of my time focused on whatever that thing is that I want to do. And that was a really good mix for me, because I tell people, don't be so focused on what you're doing. Don't be so laser focused on what you're doing that you're not thinking about where you're headed. You're not thinking about what's next. You're not paying attention to what's going on in the market, what's going on in the economy, what's going on with your competitors, what's going on in your industry. I mean, you have to spend 20, 30, 40, 50% of your time doing that, so that that focus work is leading in the right place. My problem was, in 2018, I said, I want to go from spending 30 or 40% of my time kind of branching out and learning new stuff and having fun, to doing it 100% of the time. And it was great. I mean, I wrote a book on market cycles and economics, which was great. It forced me to kind of sit down and relearn a lot of that stuff that I learned back in business school. I got to focus on some fun activities, but again, there's nothing wrong with taking some percentage of your time and kind of doing the things that are fun, that are going to pay off in the future. Just don't do 100%. If your goal is to actually accomplish stuff.
Yeah. Well, let's talk about, now you've got obviously the focus, you've got the knowledge that you can put onto the current situation. So can we get an overview? You are considered an expert in the industry. I'd like to get your thoughts, just a big encompassing umbrella of what you're thinking and what you're seeing and your perspective of what's going on as of today, at least.
Yeah. So I thank you for calling me an expert in the industry. I think I'm no more of an expert than you or a million other people out there. That's not true, not a million other people, but there are plenty of yous and me's out there who are very accomplished, very knowledgeable, that have the same level of expertise that the three of us have. And I think what kind of differentiates me is I don't like real estate. I tell people this all the time. I don't like swinging hammers. I don't like being on site, dealing with contractors, dealing with schedules, dealing with budgets. I kind of like the business aspects and the higher level aspects. I like the what's the economy and the markets doing, what's driving real estate, what are the trends, so that I can focus on driving the business instead of working in the business. And so for me, because I'm not so focused on being in the business, it frees up my time to kind of focus on the bigger picture stuff. So there are a million people out there that know more about rehabbing houses than I do, and know more about scheduling and budgeting of rehabs than I do, because I focus my time kind of on the bigger picture stuff. So it's not that I'm any smarter than anybody else. It's just that I kind of focus my time on different things than most people do.
You have a unique strength.
Yeah. Yeah. My interests lie in a place that a lot of people aren't really interested in.
Yep. I get it.
So what I see now is, so I have a feeling a lot of the answers to questions today are going to be, I don't know. And yep. I'm 100% comfortable with saying I don't know. We're in a weird place right now. This is pretty unprecedented. The kind of the metaphor that I've been using the last week or so, because I really like this, is for anybody out there that's old like me and probably you guys who used to watch the old Roadrunner cartoons.
Oh yeah.
And you remember Wile E. Coyote chasing the Roadrunner, and Wile E. Coyote runs off a cliff. And what happens? He just kind of hangs in midair. He doesn't realize he's off the cliff, and he doesn't start to fall until he does what? Until he actually looks down and realizes, until he looks down and realizes what happened. And I kind of see ourselves right now as we're off the cliff, but we haven't yet looked down. So we don't know how far we have to drop. Maybe it's a foot, maybe it's 1,000 feet. We don't know what the next step is. So there are a whole bunch of people out there. I talk to people every day who are like, yeah, real estate's going gangbusters in my area. There are buyers there, there are sellers there. I'm closing deals. Lenders are having no problem making loans, although we're starting to see that change. And so basically my thought there is that there are a whole lot of people that don't realize we're off the cliff. They don't realize that today, unemployment, weekly unemployment numbers came out, and now we're at 6.6 million over the past 2 weeks. Unemployment, unprecedented. GDP is likely to slow, maybe negative 10%, maybe negative 15%, maybe negative 20%. We don't know. Absolutely unprecedented. Now, the big question is, when this whole thing is over, are we going to recover quickly? Are we going to recover slowly? Are we going to see basically a recession that lasts 2 months until we're all out of lockdown? Or is this going to be a major depression that lasts a year and a half? We don't know. But it's clear that what we're likely to see in the next 2 months in terms of economic data is numbers that have never, ever been seen in this country, that are worse than anything anybody could have imagined going back to the Great Depression. So we're over that cliff, but we haven't yet looked down. A lot of us haven't yet realized that there's going to be tough times ahead. And then the second question is, how tough are those times going to be? How long are they going to last? And what's the recovery going to look like?
Yeah, it's interesting you say that, because I've always, my thoughts as an investor like you, I'm kind of the neck up investor. I'm not very good at swinging a hammer. So the numbers dictate, the numbers are telling you a story, right? Whether or not you understand what the story is and you understand that language, and these numbers are going to tell us a story. Right now it's a bit jumbled and nobody really knows. We know that we're on the side of the cliff. We're doing the deadpan over to the camera right now to actually look at the camera before we look down. And I think that's where we are right now. We realize we're off the cliff. We're about to deadpan the camera, and we know it's going to go. And a lot of people, I think, what's going to happen is you have the normal, let's just talk real estate. You have the normal investor, the average buy and hold person, and that starts reverberating out. And then maybe you have the non-normal Airbnb, and then you have the non-normal Airbnb arbitrage. And you have these things that are so far off center. I think whether you call it coronavirus or 2008 recession or 9/11 or Hurricane Harvey, the industry has a way of righting itself.
Yep.
And I think what's going to happen is a lot of people that do not have sound business models and were not leveraged correctly and maybe did not have a capital set aside, they're going to realize that their business model is not sustainable when that pendulum swings back the other way. And I'm curious your thoughts. Do you think some of these people will be able to sustain that have these, these kind of far left type business models, or do you think they are going to get cleaned as the pendulum comes back?
Yeah, I think there's a lot of it depends. So let me step back a little bit. Let's talk about unemployment, for example. We all know unemployment now is going to go to like 30 million. I mean, there could be 30 million people unemployed by the time this thing is over, but nobody really believes that we're at a point in this economic cycle that there's 30 million unemployed. It's just the factor of we're locked down. So the day the lockdown ends, or the day the lockdown starts to end, that 30 million goes to 25 million, 20, 15, 10, 5 million, whatever that number is. And so we go from 30% unemployed back up to maybe 5 or 6 or 7 or 8% unemployed. Now, if you think about it, that's still a lot worse than where we were 2 months ago at 3.5% unemployed. So we're right now we see this massive crash in unemployment, and at some point soon we're gonna see that number come back to settle in at something a lot more reasonable, something we've seen 100 times in the history of this country. But it's not going to be as good as it was a couple months ago, in my opinion, because think about this: if every business out there that was in business going into this whole coronavirus thing were to continue in business after this thing was over, we'd get back to 3.5% unemployment. But the problem is not every business is going to come back. I was interviewing a guy on my podcast last week. He's the owner of the #1 bar in the country. And he said, talk in the restaurant industry is, and by restaurant industry, I mean the major restaurant associations, talk is up to 75% of all independent restaurant owners in the country may go out of business because of this, may not come back. Now, let's say that number is ridiculous. Maybe it's 50%, maybe it's 25%. But even if 25 or 20% of restaurants go out of business, that's millions of people employed that no longer have a job. Now, where are they going to go work? Well, other restaurants are just starting back up after this thing is done. They're not going to have as tremendous a demand as they had before because people are still in financial struggles. People are still getting over this virus thing. The lockdown's likely to be a more phased approach out. So even if it's only 15 or 20 or 25% of restaurants go out of business, that's millions of people that don't have a job. Now, over 6 months or 12 months or 24 months, obviously all those people are going to be reabsorbed back into the workforce. At some point in the near future, we're going to get back to 4.5% unemployment. But there could be 6 months or 12 months or 16 or 18 months where unemployment is pretty high. Likewise on GDP, we're going to see GDP drop to -15 or -20%. That's ridiculous. Nobody really believes that's like where we should be. That's just a function of the lockdown. So as soon as the lockdown ends, that number is going to bump back up, but it's probably not going to bump up to 2.5 or 3% where we were before the virus. It's going to bump up to maybe 0% or 1% growth. And over 6 or 12 or 18 months, it'll eventually hopefully get back to where we were. Same thing in real estate. Right now with real estate, what we're seeing is everything is kind of strong. What I think is over the next month or two, we're going to see real estate do exactly what GDP and unemployment and all the other measures have done. We're going to see it drop off a cliff. Right now in a lot of states, real estate agents can't show houses. They're not allowed to physically walk into a house with a client. Doesn't mean clients aren't seeing houses. Doesn't mean off-market properties aren't selling. But for the most part, the whole model of real estate sales is breaking and stopping. And I think in a month or two, we're going to see real estate absolutely fall off a cliff. But just like with GDP, just like with unemployment, once this lockdown's over, it's going to come back. I don't think it's going to come back to where it was a couple months ago. I think it's going to take 6 or 12 or 18 or 24 months, just like unemployment, just like GDP, to climb back to where it was. So the question is, what can we as investors do for the next 6 or 12 or 18 or 24 months while real estate is depressed or recessed or somewhat push down. What can we do to outshine our competition? Because right now, just like not every restaurant's going to come back and not every service business is going to come back, not every real estate investor is going to come back. There's going to be enough deals, there's going to be enough houses, there's going to be enough work out there for a lot of us to get back to work as soon as this whole coronavirus thing is over, but not all of us. And so if you're kind of in that bottom 25% of real estate investors, you may come back and find there's no room for me. So you need to figure out how to be in the top 25 or top 50% just to have a job when this whole thing's over.
Well, and I think what's going to happen, you're going to see a lot of people, many people in the real estate industry have never gone through a crash cycle or a recorrection, we'll call it. So I think a lot of people are talking right now saying, I heard about this, but I didn't realize it would happen this quick, right? Because this was a flip. This wasn't like, hey, things are slowing, I better start selling my assets or getting cash. This was a flip of a switch. And like you said, I agree that it's going to ramp up, but it's not going to be like the government's going to flip a switch and all of a sudden everyone's going to be booking vacations, and I wonder, once these businesses start up, they have to make the money before they can actually pay the employees, because it's not like they've been stockpiling money and all of a sudden they let the gates go. I'm thinking, in my mind, it's going to be at least 30 to 60 days till people can actually start getting their paychecks again.
Yep.
Because it's got to work its way through the system, vendors and all that stuff. So I'm curious your thoughts on that. How if you agree or not.
Yeah, absolutely. So we often talk about these crashes or recessions in terms of what shape the economic curve looks like. Is it a V shape or a U shape? Where the V shape is kind of, we see a crash down and then a jump back up. That's the V shape. And the longer, more drawn out recession type event is referred to as a U shape. We kind of see a gradual trend down. We have a bottom that lasts for a little while, and then we see a gradual trend up. And so we often talk about recessions in terms of, is this going to be a V-shaped recession or a U-shaped recession? I'm starting to think that this is not going to be either of those, that this is going to look more like, for lack of a better example, a Nike swoosh. So if you know what the Nike
check mark, I was actually thinking a check mark.
Yeah, a check mark, exactly. We're going to see a quick drop down and then a nice slow ramp up back up, for the exact reason that you said, that this isn't a binary thing. This isn't a flip of a switch. It's not like lockdown, then no lockdown. This is lockdown, then maybe 20% of people get back to work 1 week. And then 6 weeks later, 50% people are back to work. And then 3 months later, 80% of people are back to work. Oh, and then there's maybe a resurgence of the virus when fall comes around and the weather starts to get colder and we have to do a mini lockdown again, and we do that double dip. So nobody really knows what it's going to look like, but I think it's safe to say that we are not, and I know this is going to disappoint a lot of people, and I know a lot of people are probably going to write to you and say he's an idiot, he doesn't know what he's talking about, but I think anybody that thinks that come August or September that we're going to be back to where we were 2 months ago, I think that's just not realistic.
I agree.
So there's a lot to unpack here. Like,
Alex, you've been quiet, man.
I've been thinking, and I've been listening very very carefully. I think what the model you put together is makes a lot of sense. I think it's based in some true economic realities and data as we see today. I also have a couple of things. Like my mind is entrepreneurial. Like I'm going into the opportunity. What is the opportunity? What is the opportunity on the down? What's the opportunity at the bottom? What's the opportunity coming up for businesses, for real estate investors? I don't necessarily just want to talk about real estate investors, because I believe the nature of work is going to shift. Like there's going to be so much. Like you can subscribe to toilet paper, guys. You can subscribe to toilet paper. Legit. They're like gangbusters. They're going like gangbusters. So, who knew? But the point is, I think the consumer spending right now is so depressed, especially with the lockdown. People has got nothing to spend on. And even if you spend, you're not going to get delivered because there's Amazon's prioritizing these essentials. And so I think we're going to see a lot more, I wouldn't say roaring comeback, but the comeback is going to be, because people are pent up, and there's a lot of, And yes, some people lost their jobs, but the stimulus package is pretty good instrumented to help replace some of that income for, up to 39 weeks, which is a significant amount of time.
Yeah, but there's something else to think about. And we saw this after 2008, which was a major recession. Back in 2008, one of the things we saw was even when wage growth returned, even when average salaries returned to where they were pre-2008, we didn't see the same demand.
Because we're not on a lockdown, Jay.
Well,
we're not on the house arrest.
But I think it's more than that's the physical component. I think there's a psychological component there as well. It's kind of like, remember the last time you got really sick, you got a really bad stomach bug, and you're in bed and you're feeling like crap, and it's like, ugh, I can't eat a single thing. I feel so horrible. And then 2 days later, you're feeling better. Physically, you're feeling better. But emotionally, you're just like, I still don't want to eat because I remember how bad I felt, and I just don't want to go back to that place. And it takes a few days or a week before you like kind of forget how bad you felt physically and psychologically before you get back to life as normal.
Does tequila count? Because if so, I know exactly what you're talking about.
Actually, that's the perfect example. You climb into bed, the room is spinning, and you're like, I am never going to take another drink again. You wake up the next day and you're hungover, and you're like, oh, I can't even think about drinking. 2 days later, you wake up, you're not hungover. Physically, you're feeling fine, but psychologically, you're still like, I'm not ready to start drinking again. It takes a week or two.
Right away. But that's just me. Let me give you this one analysis. I just wanted to finish my point with this. Okay. So you, Jay, are speaking very wisely, but you're speaking of a recovery and comparing that to 2008. And, Steve brought up a disaster, Hurricane Harvey. I agree. There's depression in the locale where you're in. I think what I'm seeing and what I'm sensing is more like winning a war rather than going out of the recession. Like this is the World War II, when it was over, like the recovery and the significance of that event winning is, to me, is different on people's attitudes and how they behave. Like, what are your thoughts on like the complete difference of the nature of the disaster and the fight we're putting out?
Okay, so let's use that analogy to World War II. So in the analogy to World War II, are we the Americans that were sitting at home watching the war on TV, and the day it's over, everybody's excited that we won and is out celebrating? Or are we the troops that were actually fighting that war, and the day it was over, we were still traumatized and had PTSD and maybe never got back on track in our lives? And that's kind of the distinction we have to make. So for the people,
doctors, Jay, sorry.
Say it again?
I say those are the troops are the doctors.
Yeah, but in a lot of respects, there are also a lot of us. There are a lot of people out there that don't know how they're making their mortgage payment this month. They don't know how they're going to buy food because maybe they don't know how to apply for unemployment, or they're not getting as much money, or whatever the reason is, and they're scared. And they're like, if this lockdown lasts another 2 or 3 or 4 months, I'm going to be broke. I'm not going to be able to pay my bills. Maybe I have medical bills that I'm not going to be able to pay. And that scares people. And fear, you don't necessarily recover. It's not necessarily like Steve used the analogy of a switch. It's not necessarily, okay, we won the war and the fear goes away. There are a lot of people that are sitting in their houses and they're so scared that once this ends, they go, I need to change the way I was living my life. I need to start saving money. I need to be more careful. I need to find a better job. And maybe I think that wears off. I mean, eventually people fall back into their bad habits. But it could take 6 or 12 or 18 months before people fall back in their bad habits. And for that 6 or 12 or 18 months, they may decide to save their money instead of going out and buying a Rolex or buying a fancy car or upgrading their apartment or buying new furniture, or who knows? I don't know. And that's the point. I know after 2008, we saw a lot of people who were scared because they were traumatized. And we talk about millennials. There's still a lot of millennials. I mean, we use the example that millennials don't buy houses. Why don't millennials buy houses? Because they lived through 2008 and they saw what their parents went through. And they're like, I never want to deal with that. So here we are 10, 12 years later, and millennials are still scared to buy houses because of what they went through. And you may be right. Maybe this is more of a quick war that we don't come out traumatized. And In that case, it may be nothing like 2008, but I don't know if we know that yet.
I wouldn't say, just 1 second. I wouldn't say it's quick. Quick was not my point. What I was saying is I think of more of a V than a check mark, but I understand the check mark mindset and how the check mark sort of looks when we're seeing where we are today, from where we are today. Steve, what are you going to say? Sorry.
I think, Alex, in your mind, you're combining two different analogies. So the analogy I'll say is you, in your mind, it's like a bunch of sailors on an aircraft carrier that are going to dock in port that have been saving their money and making a bunch of money. And then when they get to port, they're going to go crazy and party. And I think that you're thinking that. I think of this more of Tom Hanks on the island getting beat up for 5 years. He didn't get off, once he got rescued from, I forget the name of the movie, he didn't all of a sudden get back in town and be like, I'm going to light the world on fire. It was like, you know what, I'm going to kind of rethink my life and I'm going to reassess. And you know what, I don't even have any money in my pockets. So I've got to start making some money, because I think you're assuming people are stockpiling money right now. And, World War II, the different situation was that people were still working and having jobs. Right now, it's like the whole line of the world just dropped and everyone is at a lower level. So nobody has money in their pockets to go out and go like, let's go support the economy. Let's go out and eat. They're going to be like, well, shit, I don't even have a job. Like we talked to Chris in Vegas and he said his brother just laid off 3,000 people from the MGM. I don't think those people are going to be like, hey, let's go gamble and support the casinos when this.
But don't forget, there's a $2 trillion. So I don't disagree completely. There's probably something in the middle, but there's going to be a sense of winning, and there's $2 trillion. That's just the beginning.
So keep in mind what's the GDP in the United States? It's about $22 trillion a year. So our GDP for 1 month in this country is about $2 trillion. So basically the money that they released, and keep in mind, it's not stimulus is not efficient. That money is going out through banks and most of it's going to big companies. So in theory, it trickles down to us, but it's not going to be 100% efficient where all that money trickles down into the economy. So that $2 trillion is basically just status quo. If it were completely efficient, if it were efficiently released into the economy, that's just keeping us where we were. It's not like that's going to create pent-up demand. I think, and we've already been here. It's been more than a month. We're here. It's been 4 or 6 weeks for a lot of people, especially you're in the Bay Area. So it's been longer for you than a lot of people. I mean, I really think that by the time this is all said and done, it's going to be $5 to $10 trillion. It has to be just to keep the status quo. I don't think that 5 to 10 trillion is going to generate pent up demand. I think that's just going to keep us going.
That's right. And that's all we need to do. If we are on the other side and people are pent up and ready to sort of live their lives. So let's not forget, people want to live their lives as well. Like we're in America, not to be just surviving. Like we want to thrive, right? We want to be opportunistic. So, but let's set that aside. Let's talk about the opportunity, like whether it's a shorter cycle and more like and faster, or is it longer, more drawn out, as you pointed out, Jay. What's some of the opportunities? New businesses will come out. Some businesses will die. Like let's talk about trends. Like you're a trends guy. What are you seeing emerging?
Yeah. So I know most of your listeners are probably real estate folks, so I won't belabor this, but I think for anybody out there that is looking for an opportunity to jump into a non-real estate related entrepreneurial venture, like a business, starting a business or buying a business, now could be the 2008 of opportunity for businesses. So basically when we come out of this, like I said, restaurant industry is talking about 75% of restaurants, potentially independent restaurants, going out of business. Like that number probably won't be that high, but if any significant number of restaurants go out of business, there's going to be opportunity in that segment, in that industry, because there is enough demand for probably more than will exist at the time it starts. There are going to be a lot of people, my wife and I talk about this all the time, that there are a lot of people who are always hanging kind of on the edge, on the thread with their business. They're like, oh, things aren't going well. Should I shut it down? Okay, I'm going to give it another month. I'll give it another 2 months. Maybe I can turn things around. I'm not doing too well with my partner. Things aren't going well. I'd love to break things off with him, but that's just too difficult to break things off. Well, let me tell you something. This event is going to make that decision for a whole lot of people who are thinking, should I continue my business or not?
It's a ripcord for people.
Say that again.
It's a ripcord for people.
Absolutely. So there are going to be a whole lot of industries that are probably, there's going to be more demand than supply. So for anybody out there that's looking to get into entrepreneurship from the business side, this could be the best opportunity in decades, especially if you want to buy a business, because there are going to be a lot of people who are just like, okay, I think this is a good time to retire. I've got these assets. I might have some cash flow coming into my business already. And there are going to be a lot of people who are going to be selling businesses over the next few months, I think. So that's one thing to consider.
Jay, I've got so speaking of that, I'd like to talk about your knowledge on the SBA loans that have been pushed out with. There's some that are going out to investors for the ability. How familiar are you with that whole world?
I'm a little bit familiar. Actually, I'm going to have an SBA expert on my podcast next week to talk about this. So I've been forced to, and my businesses, we've looked into these. So I'm somewhat familiar. Yeah.
Okay. What can you give us some insight as to what it's about?
Yeah. So basically the SBA, the two major programs, and they've got lots of programs, but the two major ones are, there's a disaster loan program where essentially you can apply for a loan where they'll get you $10,000 basically tomorrow if you apply today, and then they'll get you the rest within a week or two. If basically your business is at risk of going under very quickly, you can't pay your bills, you really need a lifeline, they'll give you a long-term, I think it's 10-year loan at a very low interest rate. I think it's like 3 or 4%. And that's one way to go. Then the other big program is what's called PPP, or Paycheck Protection Program, which is one that's just rolling out tomorrow. I don't know when this is airing, but it's rolling out April 3rd, Friday. And that's basically where they're saying if you're a small business under 500 employees, take your average monthly payroll from last year. Let's say last year, your average month you paid $50,000 in payroll to your employees. Multiply that by 2.5, so that would be $125,000. We'll give you $125,000 to basically pay your payroll and your rent or mortgage and utilities expenses over the next 8 weeks. And if you take that money and you actually put it towards paying payroll, you don't lay anybody off, you don't cut anybody's hours, for the next 8 weeks, you don't have to pay that money back.
That's right. It's be forgiven. And the interest rate, if you do, it's 0.5%.
It's 0.5%. And I think it's defined
for my business. I just finished the application process to be sort of ready. Yeah, that's a fascinating program.
Yeah, it's amazing. I mean, basically, I don't want to say free money, because basically that money is going to your employees. So whether it goes to your employees in unemployment if you have to lay them off, or it goes to your employees in payroll because you get to keep them, I mean, that's a great thing. And it provides some business continuity.
But exactly. But Jay, what the opportunity is, the smart business people, this is like 2 months to retool.
Yep.
You have who else ever, you guys, I don't know, like this business that I own has, 22 employees, and we've been at it for a long time. And, we're serving certain constituency. It's the marketing for property management companies. And there's just so much opportunity to take the 60 days and reposition and open up new opportunity lanes. So that's why I'm pretty bullish about it, because I'm living in this. And also, like, my wife, she stopped working because she has to take care of our kids. Like, who's going to homeschool? She's not a teacher, so she has to become one. So we have 2 little girls. And guess what? Like, the government is almost replacing almost all of her income. So I'm pretty optimistic, given that my business is being safe. My job is exciting because I got to grow a company to potentially a B in this economy, and we can do it remotely, and things should be okay in the property management side, although I want to hear your thoughts on that. And then on the family front, it feels okay. So, and a lot of my friends and people I speak with in my network, it seems okay. So, to me, it's a little bit less bleak. But if you apply the laws of averages and how sort of most people would do, probably most people won't do as well. It took me a long time to get up to this level, like years. I'm an immigrant, so it took me 20 years, go through college and be poor for a long time. I wouldn't say that I'm rich at all, but I have all these assets, not a lot of cash. Maybe that's
Here's the thing with your take on our recovery and my take and Steve's take. I have all these people that like want to talk about this and like almost want to argue. They're so adamant in their position. Our recovery is going to look like this, or this is going to be the next Great Depression, or this is going to be whatever they think it is. And what I like to tell them is, I'm not going to argue with you. Because this is, I don't know, even if this were a normal economic cycle, this weren't this crazy event, even in a normal economic cycle, I will never try and predict when it's going to happen or how bad it's going to be. Because the best economists in the world during a normal economic cycle can't tell you those two things. So during this crazy event, I'm certainly not going to argue that I know what I'm talking about and you don't, because I don't think any of us knows. Here's the other thing to consider. And I think a lot of what happens in terms of longer term economic stability coming out of this is going to depend on two things. One, how long this whole lockdown thing lasts. So, I mean, we have people talking about how in 2 weeks we're going to be out and everybody's going to get back to normal. Everything's going to be good. Then you go to the other extreme and there are people, in 18 months, we're still going to be locked down for the most part because we need to wait till we have a vaccine because otherwise the virus is going to reemerge. Most people are somewhere in between. Most people are, it's going to be a month or 3 months or 4 months. But there's a big difference between lockdown for another month and lockdown for another 4 months. I mean, again, in a $22 trillion economy, the difference between a month and 4 months is $6 trillion in GDP. So that's going to play a big role. How long are we locked down? The second question is, what is the government going to do? Are they going to do the minimum? Are they going to basically just try and keep things going? Or are they going to do just the opposite? Are they going to throw everything they have at this? And personally, I've talked to, you guys probably know Kathy Fettke. Kathy and I have talked about this a whole lot. I personally, and she personally believes that Trump wants to get reelected. And this isn't, again, this goes back to that, it's partisan, but it's not emotional. Anybody that's president right now wants to get reelected. How do you get reelected? You have to have a strong economy. So Trump is going to throw everything he possibly can at this, $5 trillion, $10 trillion, whatever it takes to try and keep the economy moving. So over the next 6 months leading up to the election, we're going to see a lot of stimulus. We're going to see a lot of QE. We're going to see a lot of money flowing into the economy.
Exactly right.
My question is, what's that going to break? Because we like to think of, you put a whole bunch of money into the economy and everything is good. But you just look over the last 2 weeks, all this stimulus, all the bonds and mortgage-backed securities that the Fed has been buying over the last couple of weeks have driven interest rates down, which have caused secondary lenders to get margin calls on their hedges. And I know I'm going into complicated stuff here. Long story short, all that money that the Fed has put in has really hurt big lenders over the last couple of weeks, and they've lost tons of money because the Fed's trying to save the economy. And so this good thing that the Fed's trying to do is causing things to break down the line. Well, that's $2 trillion. In fact, that's not even 2 trillion for the QE. It's like 1.5 trillion. Well, when we start getting up into 5 and 10 trillion, what does that break? Because these things have never been tested. We don't know how these things work. And so it's possible that we get 4 months in and we realize that all this stuff that we're doing to try and save the economy, maybe it's destroying the economy in some other ways that we couldn't even have predicted.
Yeah. And, Jay, just something I just want to back up. You said a couple of things I think is important for anybody in any kind of business. Whatever you focus on will manifest. And I think a lot of people, they want to argue the fact because they want to be right that it's a horrible situation.
Yep.
They want to prove you wrong, that there's no solution, that this is going to be just a horrible deal. Alex is going to the path of saying, hey, you know what? It could be horrible, it could be bad, but I'm going on the good.
Yep.
And I think that a lot of people, and I've talked to a lot of people that are telling me how horrible things are, and I'm like, well, there's two ways to look at it. You can look at it as horrible, or you can look at it as there's going to be a lot of opportunity to be successful.
Yep.
Which way you wake up and choose is your own thoughts. And, I think you can get equal conversations and arguments to either way, but which one is going to make you better and happier at nighttime and sleep better? That's the question, right? And
that's a good point. Go to bed with whatever makes you happy, but wake up with an open mind thinking whatever gets thrown at me today, that's the direction I'm going to go. I'm not going to have any preconceived notions. I'm not going to go plan my strategy out for it being this type of recession or that type of recession or this type of recovery or that type of recovery. I'm going to plan based on what I'm seeing. I'm going to actually take in the data and I'm going to adjust. And the best investors, the ones that are going to succeed today, just like the ones that succeeded in 2008, are the ones that are flexible, that are smart, and that can adjust their strategies on a dime. I credit my wife because she's really good at this. She's really good at seeing trends. And 2008, 2009, she's like, we need to be doing REOs because REOs are where it's at. Before everybody else was doing REOs. And then a year before everybody started doing short sales in 2011, she's like, we need to, I'm starting to see a lot of short sales come on the market. Investors aren't noticing this. And a year before short sales got really big in 2011, we started to shift our strategy and get ready. 2013, my wife was like, short sales are drying up, but I'm starting to see like builders coming back and starting to build again. We need to start doing some infill lots and starting to build. So we got into new construction and basically just trying to stay 6 or 12 months ahead of all the other investors. And it's been amazing. I mean, it's like I talk to people and they're like, oh, you were building a year before everybody else was building. How did you know? And it's just like, just pay attention and be flexible.
Well, and I think knowledge, I think if you have the knowledge, it's like, Alex, you're a black belt in martial arts, right? You have all these knowledge of arsenal in your mind that when something comes up, you're just using what you've learned over the years and you're practicing and it just comes out. Same thing when you're buying real estate or, I can look at a deal just like Jay, you could, and go, you know what, that's an owner finance. That's going to be a wrap. I'm going to flip that. That's from the knowledge. That's not a guess. That's us looking at it. And people may go, man, how did you know that? It's from years and years of practicing a craft and knowing so that you can be intelligent enough to see the trends that are going to happen based on studying and learning and focusing on the craft. Jay, you just did that event with Charles and Ken and Kathy. Was there anything that came out of that you learned or was like, something you didn't think of that is, knowledge-wise?
Well, I thought it was interesting because I own probably I own a whole lot fewer units than Ken does. He's like 8,000 units, and Kathy owns a whole bunch of single family and does syndications. What I found most fascinating, what I've learned a whole lot about, is the property management piece and the large scale dealing. And I'm sure you could talk about this, and you could teach me a year's worth of knowledge, is just this whole buy and hold and dealing large scale with tenants and all the rent issues that are coming up and how to deal with basically potentially tenants who they're going to be tenants who clearly can pay and will pay. And then the other extreme, they're going to be tenants who have lost their jobs. They can't pay. They're not going to pay. But then there's that whole 60% in between, those people that potentially can pay or potentially could pay something, but don't want to pay anything. How do you deal with that? And how do you as a landlord deal with maximizing your income, keeping up on your mortgage payments, your debt service payments, your utility payments, all of your payments, when you have tenants that are kind of either struggling or pushing back on trying to pay you? And so I'm talking to Ken, talking to Kathy. You guys probably know Chris Clothier from Myndful Invest. Chris has been sharing all of his data. He manages 5,500 units, and he's been sharing a whole bunch of data with me on his tenants paying and not paying, and acquisition and disbursement. And so for me, this has been the most interesting part of this, because that's a world that I don't typically live in.
Yeah, I can, I'll let Alex talk on this because he's kind of at the center of the nerve on this, because, we're managing close to 10,000 properties in 16 regions. So we're not just region specific. We're dealing with a massive level with laws, different environments. Like I said, Vegas is shut down. We've got operations in Vegas. So that we're dealing with a lot of different idiosyncrasies that not all management companies. Most management companies are geographed in one area. I know Chris has different locations, but at the scale at the scale that Mynd is at, it's another level. And Alex, I'll let you you've been in the brain trust of everything going on, the heat of the brain center. So why don't you talk on that, Alex?
Well, I'll mention a few things. I don't want to age this show because this is ageless. Like, I really, really like how Jay sort of packaged that all up for us. and gave it to me to slice around and play around a bit in the sandbox. So that was good. I don't want to age the show away, but like just a very few things. Number one, we're putting what we call a mind management ticker on our situation room, where we're going to share the following things: delinquency, like last week versus 6-month trailing average, new property management agreement signed versus last 6 months. So we're going to have new leases signed, new move out notices. So we want to like put that together, and then we want to share it by market. Now, that's the aspiration. The doing of it is not that easy. We have a fairly large team, and turning things around this quickly is hard. So by the time this show airs, maybe we'll have it on the situation room at Mynd.co. But the early indication is like we had 40 to 45 people say, out of like 8,000 or 10,000 residents, say, look, we're not going to be able to pay. Can we work something out? And we're working with them. So we have a payment plan, and we have very specific way we approach this issue. But so far, what I hear from other managers is 3 to 6% is the delinquency.
Okay.
But it's only the second.
It's funny because I figured you weren't going to want to talk about this on the show because it's like me interviewing you guys, but this is what I find interesting. And I was going to ask you about it after the show, just the data that you were seeing. And I guess we're only on the second day of the month, so it's probably a little bit early for you guys. But that's what I find fascinating. I think that's what a lot of investors out there who are thinking. I mean, think about it. Buy and hold has always been one of those strategies that's no risk.
Solid. Rock solid, yeah.
Yeah. Nobody's ever thought about the risks in buy and hold. What's the risk? Oh, yeah, maybe I have a vacancy for a month or two. Nobody thinks about this systemic risk that now buy and hold is forever going to be like, well, it could happen. It's not likely. This may not happen again for 200 years, but it's not out of the realm of possibility.
Well, and I think that, not to date the show, but I think the ripple effect is going to be 2 to 3 months down the road, because most people are getting some paycheck for April and working out a program with them. To me, like I've been talking to a lot of people that are buy and holders, and they're like, I don't know what to do. And I'm like, well, there's nothing that says you cannot go and renegotiate with your lender. Right? There's no law that says.
And lenders are taking calls. Sorry, Steve. Just want to interject. This is a factual statement. Lenders are taking calls. They're not putting this on the websites yet. They're taking calls. They're making concessions. Almost from what I hear, and personally, having done that, almost without giving you a lot of runaround, which is unusual for banks to do. And the second thing is the SBA loan, which maybe I interrupted Jay, didn't let him finish, or maybe he already mentioned it. But the SBA loan, they're making this available for investors as well. And some of the operational expenses may be forgiven.
Yep.
Yeah. So I think that what's going to happen, with the landlord issue, Jay, the data is going to be very telling. And that's why Alex is putting all that on the Situation Room website, so that we can start tracking the data for all of our regions and see what is going on per region. Because as anything, there are going to be some regions that are going to be very, very hit, and there's going to be some that just kind of keep on keeping. And so it'll be very telling to see what I'm curious about is, what is one region doing, or what did they do differently? Maybe was it a law? Was it something that they enacted, or was it an industry that took the bigger hit in that region as opposed to another region, whether it's tourism, gambling, whatever the case may be. So it's going to be very telling to see what these numbers tell us very soon.
Yeah. And I think this also plays into what's the recovery going to look like, because you guys know with 10,000 units, I mean, imagine if 50% of your tenants are somewhat behind on rent until July, August, September, when they get back to normal. Well, if they're catching up on rent, if they're catching up on March, April, May rent in August, well, that's going to impact their ability to go out and go out to dinner and buy furniture and
everything,
pay for all other things. So that could be an impact on the recovery as well. So it's going to be interesting to see not only how many tenants fall behind, but what the catch up looks like if things are tacked onto the back end versus are there payment plans, and obviously all that's in flux. And so I know this isn't a show about me interviewing you guys, but at some point I want to sit down and talk to you, because this is what I find fascinating, because you guys are kind of in a situation right now where you need to make up all new rules and figure out how to optimize your business. And it's crazy.
Yeah.
Okay, once we have the data, Jay, we're gonna wrap up here. We took enough of your time, but when we have the data, happy to come to your show and talk about actually just sort of put the numbers on the table and start sort of a discussion how this implications of these data points and what it might look like. But I think it'll be fairly representative of like the society as a whole, because within 10,000 we have a little bit of this, a little bit of that, a little bit of in the middle, right? So it would be interesting to see.
And they're the most investable markets in the US. So it's like it's not like we're in the Bahamas. I mean, we're in areas that people are investing in to look at and go, okay, this is a good sample size of Texas, Arizona, California, Atlanta, all that stuff. So it'll definitely be, the numbers will be very telling to see what this is telling us for sure.
So I just want to say, Steve, always a pleasure, man, connecting with you and in this difficult time, and just sort of giving our best and serving the people who listen to us. But as well as, it's very, very enjoyable for me personally, like to spend time with you. And Jay, thank you kindly for coming to the show. I know you're busy. You have big things you got to focus on. I'm very curious to hear what your next focus is going to be, but it looks like you're going to focus on something.
I'm very curious to see what my next focus. Now, there are certain things that I'm focused on now, but and this just telling everybody out there that's listening, now is potentially an amazing opportunity. We use this word opportunity probably not as often as we should. I know we have a few times on this show. We have to be using it more. We don't know exactly where those opportunities are going to be over the next 6 or 12 months, but I think all three of us know that they're going to be there. Yep. So anybody that's listening to this, take the next 6 months and start paying attention to what's going on. Figure out where those opportunities are going to be in your local market. For example, I'm in Florida, and I mean, what's going to get hit harder than short-term rentals, Airbnbs, in this whole thing. So that could be my opportunity. And so everybody lives in a different place. They have different stuff going on around them. Pay attention to what's going on around you. Figure out what your opportunity is, and be ready to pounce when those deals start making themselves available.
Yeah, that's great. That's great advice, Jay. And Alex, Jay, guys, thank you so much, Jay. I know your time is valuable, so we appreciate you taking the time to talk with the listeners and kind of get a peek into your brain for a little bit there.
I love you guys anytime.
And we'll definitely share those numbers with you. It'd be good for you to mix them in with Chris's and kind of.
As soon as I get them, I'll commit to just email them to you. I'll email them to you. Let's just call it Mynd.co. People who's listening, mynd.co. You can find our situation room there. Once we put a link, it's almost ready. I think it's ready. And again, Jay, Steve, thank you for your time. Listeners, thank you for listening. We love you. Be well, be safe, stay healthy. We'll see you in the next show.
See you guys.
Thanks, guys.